In this video, I'm going to show you how to read through financial statements. I'm going to use a company called Nextracker. It's a solar tech company, and I'm going to walk you through using the data terminal Koifin. This is coming from a framework that I've developed over 7 years in working as an equity research analyst and also getting a CFA. I'm going to show you exactly what to look for, why they're important, and what they tell us about the business. And I'm going to show you what kind of numbers you really want to see as an investor and what kind of numbers you don't want to see. So let's jump right in. This is Koifin, and I like to use data terminals because I want to see all the historical data in one place, because then that gives me an idea of how the business is developing. So here's Nextracker. This is a solar company. I'm going to jump into the financial analysis section, and let's start off with the income statement. I want to look at the revenues of the business. That represents the sales for the business. And so that represents the demand for the company's products and services. I'm looking at the growth rate first. If it's higher, obviously that means there's a lot of demand. I want to have a sense of what kind of growth rate the company can achieve. And I do that by looking at its growth rate over time. We can see that there's a clear acceleration over here in 2022, and it's been accelerating over the past few years. There's also been a slowing in 2021. If it's moving up or down a lot, that makes me think that this company is in some kind of cyclical industry, meaning the industry trends tend to move up and down, or that maybe sales are just not as consistent. Maybe there are product cycles going on. The solar industry is quite volatile. Prices tend to move up and down a lot because solar prices tend to move up and down. And so this business is likely to be influenced by market trends in the solar industry. Ideally, I want to see a consistently positive growth rate, and that is indicative that the business can probably keep growing in the future. But overall, I like that it's growing really fast. It suggests that there's a lot of demand for this company's products and services. 20-30% is really great growth rates, but I want to make a note of, I want to understand what's really driving that growth. Second thing is gross margin. So gross margin over here, we're looking at the gross profit. So gross profit is the sales minus the cost of producing that product or service plus the delivery. And then the gross margin is just the percentage of gross profit as a percentage of revenues. You can think of it, say we have a car company, the cost of goods sold would represent the cost of the materials, the components, all the assembly of putting together, all the costs that go into the car itself, as well as any delivery costs. So the gross margin represents how much money the business is making on each car. So for Nextracker, this is how much money they're making on selling their tracking devices to the solar industry. When we look at the gross margin, it's either sales or cost of goods sold, right? So if gross margins are going up, that means that either that sales are growing faster than cost of goods sold, or cost of goods sold are growing less fast than sales. So here's a test for you. How can a company raise its sales without increasing its overall costs? Any guesses? Well, if you guessed price, that's the correct answer. And that's actually a nuance that is taught in the financial industry, because say if you have a company, if you raise your prices on your products, usually that doesn't increase your costs. So that leads to more sales, but your costs tend to stay the same. So when we're looking at gross margin, because it represents the sales of the product and the cost of the product, if gross margins are increasing, that can indicate either the business is able to get stronger prices, or on the cost side, the business is able to produce the goods or services more efficiently. When we talk about the cost side, for example, if Nextracker or a car company had a production facility and it started to get more efficient with more volume, that's what we call scale in the business and investing world. And scale just means you can start to increase your profits as you have more volumes of goods sold. And that usually happens on the gross margin line. So for Nextracker, we can see that gross margins have been rising steadily over the past couple of years. That's a great sign of scale. It means that the company is able to keep the costs of its production and delivery of its solar trackers and its software low relative to the price. And it can even be keeping positive price increases on the sales of its products, even when the solar industry itself, solar prices are going down. So that's a great sign that the company is achieving scale. And again, we want scale because that just means we're getting more profits as the business grows. So that's the first profit line that we want to look at. Second thing we're looking at is the operating margin line. So here we have EBITDA margin. So it's EBITDA. It represents the earnings before interest, taxes, depreciation, and amortization. It's the sales minus the cost of producing the good and service. So that's the gross profit. And then minus the cost of operations. And here, operations refers to payroll expense, right? Things like sales, marketing, administrative expense. Those are all considered operating costs. And when we use the EBITDA metric, remember we're excluding interest. And the reason why we do that is that's considered a payment to a bank or investor. So we want to remove that so we can look at the business independent of payments to investors. And same thing with taxes, just because we want to look at the business itself. And then depreciation and amortization is sometimes excluded because it's a non-cash charge. Depreciation is like the wear and tear of a house. So for example, if you have a house and your door breaks, it's a cost, right? But it's not actually incurring any cash expenses until you actually pay for someone or repair it yourself and buy the materials. And so that's why it's considered a non-cash expense until you actually repair it. When you do the repair, that cost would be considered a capital expenditure or an investment on your balance sheet. Same thing with amortization. So amortization just represents wear and tear of an intangible asset, something like software. Say if you built some software and it starts to get out of date, it'll start losing value. But again, that's not a non-cash expense, so it's an amortization expense. When it gets replaced, then it would be also considered an investment. So jumping back into EBITDA margins, what the EBITDA margin really is telling you then is that represents the cash profits of the business. It's a really useful metric just to get a sense of what is the cash profits that the business is making from its sales, to make sure that we're not being too skewed by removing the depreciation and amortization. One thing you can do right away when you're looking at margins is to make sure to compare the EBIT margin, so the earnings before interest and tax. So you include depreciation and amortization expense, as well as EBITDA margins, and just compare to make sure they're not too different, right? Because if they're too different, then that means that there's a significant depreciation and amortization cost. And obviously, wear and tear is an important cost for any business. Now, next tracker over here, right away, that tells us, because they're not that different, one thing that tells us right away is there's not a lot of D&A or depreciation and amortization expense. So we can use either one, both useful indicators of the business quality and business performance. So going back to analysis, when I look at margins, I basically want to see positive operating margins, either EBITDA, or earnings before interest, taxes, depreciation, amortization, or EBIT, earnings before interest and taxes. And ideally, margins to start trending up. So why do we want to see it positive? Because one, it means the company is profitable. It means it's actually making money on its sales. And really, that just makes life easier for you as an investor. Because if we think about the flip side, if a company is not profitable, it usually means that there's a limited timeline of cash that they have to burn, right? Because they have to keep funding their operations if they're not making any profit. And if they don't become profitable within that time period, they usually need to raise money. And if you raise money, it really becomes messy because you have to start to incorporate the effect of capital raising. Because when you raise money, if you sell shares, it increases the shares that are outstanding of the company, which dilutes your share of the profits. And you also, of course, have to make a guess of the profitability of the company in the future after that capital raise. So I like to see companies generating positive profits, so positive margins. And really, it's because if a company is making money, it can start to use its own earnings to fund its growth. And that becomes really important later. So I want to see margins going up. That indicates that there's efficiencies in the company's operations. So when we look at the gross margin trend, say over here, we're seeing it's going up, and the EBITDA margin trend, when you compare those two, you can start to see where the efficiencies of the company are coming from. If it's coming from gross margins, you know it's coming from either price or they're just getting more efficient in the cost of production. They're getting the benefit of scaling and just getting more profitable as they grow their volumes. It's like having more profit per unit of product, which is a great thing. If it's coming from the operating margin side, so if you see gross margins stable and operating margins increase, that means the business is just becoming more efficient in using its operating costs. So things like sales, marketing, or administration of expense, really it means the business is becoming more efficient as an operating entity. And when a business can create efficiencies in the operations, we call that operating leverage, meaning the sales go up and then the operating margins also go up. And that can happen, for example, if, say, a company trains its sales force to get really productive, so each salesperson can just make more sales each day. What happens is as the company grows its sales, you start to see an expansion in the operating margin. The point here is when all this talk about margins is when we invest in a company, we want to get comfortable that the business can both scale, so get more profitable as it sells more volume, and also have some kind of operating leverage, meaning the business just becomes more efficient at using its expenses in sales or marketing or even research expenses. Because if they can achieve both of those things, that just means more profits for you as an investor as the business grows. And gross margins are particularly important because if you can't generate a profit in your own products and services, you're never going to generate a profit in the overall business, no matter how efficient your sales or marketing becomes. Going back to Next Tracker, I can see that margins are going up in gross margins, which is a great sign. So they're getting more scale, and EBITDA margins are going up as well. So they're also getting more efficient in their business operations. So that's a really great sign. So that's why I think it's an attractive company to look at. One thing you do want to be careful of when you're looking at margins and looking at the trend of margins is that it can be very easy for a business to expand its margins during good times. It's just easier to be profitable when you're generating a lot of sales. What you do want to do is you also want to pay attention to times where the business slows down. Maybe there's a recession or the environment slows down, and you want to look at what happens at margins during that point in time. So if we look at Next Tracker, in 2021, we had a pretty significant slowing in growth rate. That year may have been a particularly difficult year for the business, and that's why growth rates slowed all the way down to 2%. You can see that the change in the gross margin was still positive, but not as much as it had been from the prior year. Same thing with the EBITDA margin, it stayed roughly flat. So you can see that there is what they call a negative leverage effect sometimes, where margins tend to go down when business growth slows. So you want to pay attention to that because we want to make sure that the business can remain profitable even when trends slow down. That's indicative of a well-run business. Over here, we can see that profit margins still went up, even though growth slowed a little bit. So that indicates that the management is running the business well and the company's products are profitable on their own. Okay, final thing on the income statement. I want to look in the net income. So net income is after taking away the interest and also paying taxes. So that represents the actual earnings that the business is generating that belongs to shareholders. For net income, what I'm really looking for is a positive net income or getting close to positive income, because that means the company is just profitable and generating earnings for its shareholders. I'm not too worried about the margin because one, operating margin is a better indicator as well as gross margin of the company's overall profit. So I'm just making sure that they are profitable and it's improving. Net income margins can be improved by figuring out ways to reduce your interest expense, reduce your tax expense. And those things are all well within the control of a good business. The more important thing that I want to look at when I look at net income is I want to look at the earnings per share. That's what EPS is. Earnings per share is important because I want to adjust the net income for the amount of shares outstanding. If a company decides to raise money by selling stock, that'll raise the number of shares. So that's going to dilute the earnings per share. And so that lowers and dilutes our share of the overall company's profits. So earnings per share is super important because it represents our share of the profits that the company makes as investors. So we want to look at the growth of EPS because at the end of the day, the growth in earnings per share is what increases the value of our stock because it represents our share of the profits. So as long as earnings per share can go up in the future, that means the value of our shares will go up. Assuming, of course, the valuation of the stock remains stable. But that's another thing to check in the future. To recap the income statement, high level, want to look for steady growth trends. I want to see signs of positive and expanding margins. And 3, I want to see positive growth in earnings per share. That indicates that this is a business that's growing and it's profitable and it's making money for investors. What I don't want to see, ideally, is inconsistent or declining growth. It means the business is shrinking. Or negative margins. It means the business is having trouble with its costs or prices are coming down. Or a decline in earnings per share. It means the company is no longer growing its profits for investors. Now that represents a business that's just having trouble growing and is having trouble making a profit, which both things will make it difficult to make money as an investor unless you're playing for a stock that'll significantly change in value. But that's a different kind of thing to talk about. Now let's look into the balance sheet. So over here, I'm going to jump into the balance sheet. Now, what I'm doing when I look in the balance sheet is I want to basically make sure that the business is financially stable. So first thing that I always check when I look in the balance sheet is I want to check the cash balance. I want to see, does the company have cash? And ideally, is that cash balance going up? Because that means that the business is hopefully generating that cash. And if the cash balance is declining, one, that indicates that either the company is just not profitable because it's using all its cash in its bank account, and that the business is burning cash and it might require more capital. The second thing I always want to check is the debt. So that's in the liability section. I want to check how much debt it has. Now, the reason why I check that is because debt represents financial risk for stockholders because if a company cannot pay its interest and pay back its debt, that company goes into bankruptcy. And in bankruptcy proceedings, it's the debt holders that take control. They can sell off their assets in order to get their money back. And the stockholders or the equity holders are last in line to get anything. And that's why stocks go down to zero when a company goes into bankruptcy. When I'm looking at the debt, I want to look at it relative to EBITDA. So I'm going to go over here to solvency. So what I want to look at is I want to look at the net debt relative to the EBITDA. And the reason why that is one, I'm looking at net debt. So it's the debt minus the cash. So it's just assuming that the cash is used to pay down the debt. So it's just a more accurate number of the debt load. And I want to compare it to EBITDA. So remember, that's the cash profits of the business. What that kind of represents is how many years of cash earnings it'll take for the company to pay off its debt. It's a number between 1 and 2 or below. That's usually fine because what that means is the company can effectively pay off their debt within 1 or 2 years, which is not too bad. But when you start to get to 4 or 5 or 6, that's a really risky level because that's a lot of debt for the company to pay off. And they have to also most likely spend a lot of their money on interest payments. And so what that does is it actually directs a lot of the money that the company makes to its debt holders. So the company can't reinvest it in the company. They can't give it back to stockholders with dividends or even repurchasing stock. So that just fundamentally actually makes it very hard for the equity value of the company to grow. Now, when I look at Nextracker, I can see that they have a very low debt to EBITDA ratio. So I don't have to worry much about the financial risk. When I'm looking at the balance sheet, I also want to check to make sure I understand where the money is coming from. So debt is the money that comes from borrowing. So either a bank loan or selling to a debt investor. But I can also look in the equity side to see if it's raised any money from selling stock. So that's the additional paid in capital. What that represents is a company selling its shares in order to raise capital. And the second thing that I'm looking is retained earnings. So that represents the cumulative net income of the company, meaning all the historical net income is just summed up into that one figure here. So that represents the earnings that the company has retained for itself. So that's another source of cash. So you can see that it's negative over here, and that is because the company has most likely been unprofitable for a good amount of time, which makes sense because this is a fairly new company on the market. But it is improving, right? It's getting less negative. So that indicates the company is now generating positive net income because when that positive net income is added to that retained earnings balance, of course, that makes it less negative and that grows the retained earnings line, right? Because it's representing the net income that the business is generating and they're retaining for themselves. And so you can look at retained earnings as kind of a quick check on the company's history in terms of generating profits. When we think about where the money is coming from, I want to see the money coming from ideally retained earnings. So I want to see improving retained earnings, and I don't want to see actually too many capital raises from the equity side or even on the debt side, because I want to make sure that the company is one, profitable, and two, that it can raise money from its own earnings to fund operations. Because you usually don't want to invest in a company that needs a lot of capital. Because one, if a company is selling a lot of shares, your share of the earnings gets diluted every time they raise capital. And the company also, of course, needs to be able to generate a return on that capital in order to increase the value of the shares. And of course, if you raise a lot of debt, that does also tend to increase the financial risk. So it's better overall as an investor to invest in businesses that don't actually require that much capital and rather give you back capital, right? They make you returns by either giving you a dividend or repurchasing stock. They're effectively giving you back capital, and that boosts your returns. I'm also using the balance sheet to get a sense of the structure of the business and where it's investing in. So usually at this point, I'll go read the filings just to get a sense of the business does, because that'll add some context on what the balance sheet numbers actually mean. But there are a few things that you can infer right away by looking at the long-term assets and liabilities. So if we look at the long-term assets, we can see that one, that there's not a lot of long-term assets to begin with. There's not a lot of property and equipment. So I know that this business doesn't actually own a lot of infrastructure. And when I checked in the 10K, it's because the Nextracker business, they've designed it to outsource most of their production and their supply chain. That's why they don't own a lot of property and equipment. So looking at the asset line can tell you a little bit about what the business looks like. And the second major item from a long-term asset perspective is goodwill. Now, goodwill indicates that the company has made an acquisition or acquisitions in the past, because goodwill represents the premium that comes from an accounting perspective when a company buys another company. So goodwill represents the acquisitions the companies are making. Now, the company goodwill has been fairly stable over the past couple of years, which means the company hasn't been making any acquisitions over the years, and this represents an acquisition in its history. So the long-term assets tell us what the business has been investing in, and in this case, it's really just a small amount in property and equipment. On the liability side, we can also do a quick check to see what are the obligations. So it's really debt for Nextracker that represents the debt that the company has raised from its investors. And that's usually the main source of long-term liabilities. It represents what the business owes. But we can also look at other non-current liabilities to look for any other obligations that the company has. This non-current liabilities, when I check the 10K, represents a tax receivable agreement. Basically, all that is the company has an agreement to pay out tax benefits related to its stock as a result of a special transaction that it did when it was spun off into a public company. Not super important from our perspectives. I do see a big line over here for unearned revenue. So that's deferred revenue. Deferred revenue happens when you receive upfront cash payments for some kind of contract or service. And because you haven't delivered it yet, it represents a liability until you actually deliver it, and then it gets recorded as revenue. So that's usually a good thing to see a lot of deferred revenues because it just means the business is getting a lot of cash upfront for its own business. And that's great from a cash perspective. Okay, so now what does that tell me from a balance sheet perspective? Well, that tells me one, the business is fairly capital light. It doesn't own a ton of assets. And that does make it quite efficient from a capital perspective. But at the same time, of course, it doesn't own its supply chain, so it does have to rely on outside contractors. So there's pluses and minuses to that. And then from a current asset and current liabilities, basically all those things represent what we call working capital items. If it's, say, like accounts receivable, that's like payments that you expect to collect from customers, or accounts payable, so that's payments that you expect to pay to suppliers. All of those different current assets and current liabilities represents money that is expected to come in or come out within a year, and they're usually called operating assets and liabilities. I usually look at that in the cash flow statement because they're all summed up together, but what they effectively represent is just cash that is tied up in different operating parts of the business. At the end of the day, I look at the balance sheet to get a sense of the stability of the business. I want to make sure that its finances look stable. I want to understand where the cash is coming from. I want to understand its obligations. So again, just to check for financial risk if there's too much debt. And then I also get a sense of what kind of nature is this business? What is the nature of its operations? So overall, the balance sheet is always a check of the stability of the business. For a balance sheet, you want to see, one, ideally a growing cash balance. Two, you want to see modest leverage at most. Three, you want to see limited capital raises, right? So that indicates that the business is likely to be profitable and generating cash and doesn't require a lot of capital. What you don't want to see is a declining cash balance, means cash company is burning money. You don't want to see really, really high debt levels because it just makes it hard for the company to increase its equity value. And three, you don't want to see a ton of capital raises. It just means the business is sucking in capital. And if you see all those three things, it means you got a business that is burning cash, using a lot of capital, and is not generating cash. That makes it quite hard to make money on that kind of business. Now let's jump into the cash flow statement. When I look at the cash flow statement, I immediately zone in on two things. The first is I want to look at the cash from operations because that tells me if the business operations are producing cash. It's a really big warning sign if you see the company is generating profits on its income statement. So meaning the net income is positive or even the operating profits are positive, but the cash flow from operations is negative. That's a really big red flag because that means the company is not generating cash from its operations. And if it's somehow able to show that it's profitable from an accounting perspective, they might be doing sneaky things with their accounting, like booking revenues or taking in sales without collecting any cash. That's one example of a company that can be doing sneaky things with its accounting. So you want to make sure that the cash from operations is ideally positive and growing in line with the net income, the earnings per share, as well as the EBITDA. And also when I'm looking at cash from operations, here's where I can look at the working capital. So this change in net operating assets, that represents the working capital. So that's the sum total of things like the accounts receivables, the accounts payables, inventory, all the stuff that represents cash coming in or cash coming out that is tied up in the business operations. And so that's summed together. That gives you a kind of blank number of how much capital is required for the business day to day over a year. And now that becomes useful because when we start to think about the future of the company, once we get a sense of the cash earnings of the company, either with operating income or EBITDA, we want to adjust that for the working capital. So once we have an idea in mind of the working capital of the company, we can adjust that in order to understand the cash flow from operations. And then once we have the cash from operations, we can start to calculate something called free cash flow. Now I want to look at capital expenditure. Remember, capital expenditure represents the reinvestments into the business. If you remember when we were talking about depreciation and amortization, so that's like cost of things wearing down. When a business makes an investment, for example, it decides to repair its facilities. It might invest in building a new plant, for example. That's all included in capital expenditure. And that's because it's considered an investment. When they spend money on that, it actually goes onto the balance sheet. It goes into that property and equipment line. And it's considered capital expenditure. It's the same way with software investments. So sometimes you might see a line that says investment in software. That also becomes invested on the balance sheet. It becomes something called like a capitalized software or investments in software. That would be a line on its assets on its balance sheet because it represents an investment that the business is making into its own assets. So going to this part of the financial statement, what I'm doing is I take that cash from operations and then I minus the capital expenditure, meaning the investments in the business. So that tells me the free cash flow. So that represents the actual cash the business operations is generating after minusing the required reinvestments. And that's a really super important metric for investors because that cash represents cash that the business can use to either give back to investors, they can pay investors back, or they can make investments into their own projects. And really, at the end of the day, the fundamental value from a financial standpoint, how everything is valued is based on the cash that that entity produces. So the free cash flow represents the real value, underlying value of that company. So I want to look at free cash flow. So if we look down here, they calculate free cash flow down here. And I also want to, of course, look at free cash flow per share because I want to adjust for any share increases that happen if they've been raising capital from selling shares. So I want to make sure that free cash flow is both positive and ideally going up because then that's a sign that the business is producing cash and also growing cash from its operation. That indicates the company is growing in value. That's the key thing that I'm looking for in the cash flow statement. A couple things that I also like to keep an eye out for in the cash flow statement is one is share-based compensation. So that's in the cash from operation. I want to check how much they're paying in stock. It's a positive impact to cash flow because it's considered a non-cash expense. When you pay in stock, you're not using any cash, but it does raise the number of shares. So it dilutes your earnings as well as your cash flow per share. So when you see a really high stock-based compensation number relative to the overall cash from operations or relative to the overall revenues, you want to be mindful to use per share metrics because you want to account for that dilutive impact of issuing all those shares to pay your employees. On the flip side as well, so when I go to the cash from financing thing, I also want to see if the company is also repurchasing stock. So it's the exact reverse there. So sometimes companies will use their cash to buy back their stock. And that has the opposite effect. That'll reduce the number of shares. So that increases your share of the earnings. It increases earnings per share for you as an investor. And it's usually a great thing, right? The company is taking that cash and they're really just giving it back to you by buying back stock. And then they give it back to you by effectively increasing your earnings per share. I like to see if there's any signs of the company either buying back stock or they giving stock. Ideally, I prefer the buying back stock as an investor. And then finally, I'll just look through and see if I see anything interesting because this is organized basically with the cash from operations, the cash from investing activities, cash from financing activities. Basically, you can see this as a record of what the company is doing with its cash. So you can sometimes see some interesting things. If they're doing any acquisitions, that would come up with the cash from investing. If they've been paying back debt or raising stock, of course, that would be in the cash from financing. And also from the cash from operations, I can just see if maybe some years have a lot of use of working capital, right? So it's a picture of what's going on in the business from a cash perspective. Back to the cash flow, 3 things I like to see is I like to see positive free cash flow, ideally growing, the growth of free cash flow that is in line with the earnings. So I want to make sure that there isn't any weird accounting stuff going on. And 3, I like to see capital being returned to investors. That's indicating a business that's growing in their cash generation and giving it back to investors. What I don't want to see is negative or declining free cash flow. That just means the business is burning cash. I don't want to see a divergence from earnings. That just means some funny stuff is going on and it just requires work to figure out what's going on. And I don't want to see a ton of capital raises. Putting that all together, that just means the business is just burning cash and it's requiring a lot more capital from investors. So that just overall makes it a hard type of business to make money on as an investor. Ideally, because we as investors, we want to invest in a business and we want that business to start producing cash in the future so that it can benefit us as owners in the form of dividends or repurchases, or just for the company being able to use that cash to keep growing and investing for itself. Okay, so now let's take a step back. For each of these three statements, what you want to look for. Income statement, you want to get a sense if the business is growing and it's profitable. 2, balance sheet, want to look at if the business is in a stable financial state and using really capital responsibly, because it's a record of where they're getting cash from and where they're investing it. Cash flow statement, you want to see that the business is able to generate cash flow for its investors. At a high level, the kind of metrics that capture all those things is earnings per share and free cash flow per share, because they indicate the profits, the earnings of the company, as well as the cash flow of the company. That'll give you a sense of the change in value of the business by looking at that growth of earnings per share and free cash flow per share. But here's the thing, we want to get a sense of the returns of the business, right? We need to compare these earnings figures relative to the capital that the business is using or the business is investing in, because that ultimately represents returns. The profits that the company is making on the capital that it's using represents the returns we get as investors from owning this company, because we're giving capital to the company. So here's the two ratios that I like to look at from a return perspective. The first one is return on equity, so it's ROE, and the second one is return on invested capital. So here would be return on total capital, because both of these indicators will give me a sense of how efficient is a company at generating profits using its capital. So when we look on return on equity, what that is from an accounting perspective, so remember net income, it's just net income as a proportion of total equity. So total equity usually just represents a combination of the retained earnings plus any capital raised from selling shares. So you can just think of it as all the money that it has raised from its earnings as well as from selling shares. Net income as a proportion of that is a way to calculate the return on equity. So that represents the returns that equity holders are getting. Now, return on invested capital, what that is that is the operating profit after tax. So that's before interest, because we're looking at all capital holders, but it's after paying tax. So it's the profits of the business before paying out interest as a percentage of total capital. So both the debt and the equity summed together. So that represents the returns that the business is generating for all investors. So I tend to like to use return on invested capital. So I'm going to look at return on total capital here, because that represents returns as a whole for the business on its capital as a whole. And I want to see it, one, positive, and I want to see it showing signs of improvement, because that means the company is, one, generating positive returns for its investors on using capital. That's number one. I'm not actually looking at the absolute number that much, because the more the company is investing in, the more that number will move around. For example, if the company has just raised some money and it's got a really great project, but it's not seeing profits just yet, that number will be low, because of course, sometimes profits take a while. Sometimes projects take a while before they start to become profitable. So I don't read too much into the absolute level unless it's really negative or really, really low, because I'm caring about what the business will generate in terms of its returns in the future. So what I'm really looking for is a positive trend. I want to see, hopefully, signs that there is an upward trend in the return on total capital, because I'm focused on the returns the company will make in the future based on the capital being used today. So when it's trending upwards, that means that it's starting to see higher returns on the new profits, right? If the returns are getting higher, then that would mean that the overall return on invested capital is starting to trend upwards. And then that is a great sign, because if the business is starting to invest in things that are having high return, ultimately that will raise the stock's valuation. And that's another topic to get into. But at the end of the day, when a company can generate really high returns on its capital, one, it makes money for you as an investor, and it tends to lead to a higher valuation for its company. So based on this check, when I look at this company, Nextracker, from the operating side, I think the business looks good. I will probably want to double check the nature of its growth, but overall, I like that it's profitable. I think it's growing. From a balance sheet, it's super healthy. They have plenty of cash, not a lot of debt. Looks like they're using capital well. Cash flow, it looks like they're growing their free cash flow per share alongside earnings. I might do some analysis just to check on that. And from a return perspective, they're growing their returns on capital. It's increasing. You can see, of course, that there are some jumps and changes, which indicates that they're in an investing mode. But I want to probably look a little bit deeper, do some analysis to make sure they're getting higher returns on capital. get a better understanding of that. But so far, it looks good. It looks like they're getting good returns and it looks like it's getting higher. So that's great. So this to me is a check that this business is worth looking into. And I actually invested a little bit into it because I think it's a promising company. And then now gives me a lot of things and questions to think about as I go and start doing research and understanding this business. So for next step, I want you to look at any stock that you've been looking at. I want you to go through the financial statements just like I did. Do the same kind of check. Check the net income for growth profitability. Check the balance sheet for financial stability and how it's using its cash. And then check the cash flow statement. See where its cash is going and where they're generating cash. And then check the return metric. Once you do all that, ask yourself, does this business look like it's generating good returns for investors in the future? If the answer is like clearly no, then it might not be a great fit for looking further into. And if the answer is maybe or probably yes, then it's probably worth looking into. So that's how you can use reading financials to do a quick check on the business. Now, there's more resources in the description if you want to start to go deeper and just to help you out on reading financials when you're looking at businesses to invest in. And I also encourage you to go check out, we have a free masterclass if you want to get into deeper on how to pick stocks like professionals. Thanks for watching. If you like this, just like and subscribe so you can get more videos like this, and leave a comment if you have any questions. And I'll see you in the next video.